well. Kashyap, good afternoon. So good to have you. And of course, markets fairly volatile. One day it's up, one day it's down, fairly stuck in a range between that 23,900 to 24,000. I mean, how are you reading the sentiment? Your first take on the current mood?
So, market is obviously reacting to the comments which coming up every now and then from the president Trump. So one day there is a ceasefire which is happening. The other day things sort of died down. So market has been reacting to some of these news flows and consequent reactions on the crude oil prices as well as natural gas prices. Having said that, I think what market is also getting some bit of solace from is the fact that if you look at earnings for the Jan to March quarter, whatever Nifty 50 index earnings have come in, roughly about 54 to about 58% of the market cap has already declared earnings until date. And what we have seen is that there has been about 12 to 13% top line growth, roughly about 8 to 9% EBITDA growth. I think if you exclude IT, then there might be slightly upwards revision there, which has been more or less in line with what the market was expecting from Jan to March earning. And plus the fact that if you look at on the domestic side, there have been significant flows, which have been partially mitigating whatever the foreigners have been selling here in India. So I think if you put all this together, market is trying to find one way or the other its direction. But until we get some stability on the crude and crude related derivatives prices, I think that volatility probably might remain as it is today.
Hmm. Okay, got it, got it. We've seen that oil prices, they have been at 4-year high levels. Rupee has breached below that 95 against the US dollar. Earlier, when I was talking to the currency analyst, he was saying that, if oil continues to remain this way, I mean, Rupee can depreciate further to 98 against the US dollar. I mean, what does this tell in terms of macro risks for India and, of course, its inflation trends for you, Kashyap?
So we have seen this playbook playing also in the past. If you go back during the period of Russia-Ukraine war, also it started somewhere towards the end of February 2022. Crude oil actually made its peak somewhere around June 2022, and then it kept sliding down as a lot of sanction waivers also came in and so on and so forth. Crude remains a very important part of our overall import basket. Obviously, it forms a fairly significant part, and to purchase that oil, obviously India needs a significant amount of foreign exchange also, and it will have its own bearing on our FX rate. Besides that, what's also putting pressure on the overall INR is the fact that if you look at the month of March and some part of beginning of April, the foreign portfolio investors were also selling Indian equities, and there was a significant amount of outflows which happened there. Let's say down the line, sanity prevails, and we see crude coming back to, or even if not come back to, probably it goes significantly lower than where it is today. And what we are also going to see is significant amount of foreign direct investment flows where Indian companies have struck a lot of deals on the financials or BFSI side. I think that should provide some cushion to INR. But I mean, having said that, if the crude continues to remain upwards of $90 a barrel or $95 a barrel, then probably next 12 months are going to be extremely crucial for USD INR levels. But assumption here is that crude oil at some point of time will come down, and sanity will prevail between the two countries at some point of time.
Okay, of course, of course. I mean, of course, that's the hope that, the resolution is soon on the radar. But Kashyap, I mean, Fed, they have chosen to go hold for this meeting. But what about RBI? How do you see the rate scenario for us this year, given that oil has stayed above that $100 for the second consecutive month? Rupee has constantly declined despite the RBI-driven measures. Can we look at the possibility of a rate hike this year?
So I'm not looking at possibility of a rate hike, but so far as most of the dovish measures that the RBI had in its armory, I think CRR is something that they have already used probably to the fullest extent possible. In terms of repo rate cut at about anywhere about, let's say, five quarter. That's the bottom that I see on the repo rate side also. Then the third measure that RBI has in its armory is to do OMOs. I think they have been continuously doing that, or FX or USD INR swaps that they can do. They have been consistently doing that. So I don't see the rates, probably moving down from here. Upward movement would largely depend on the fact that if, let's say, USD INR continue to stay where, the crude oil continues to stay where it is. In 2022, what we saw was that as the crude continued to remain elevated for about 4 or 5 months, and the demand on the other side continued to remain strong, there was a trickle down effect of those crude prices on the overall inflation for at least about anywhere between about 12 to 15 odd months. Like I said, everything hinges on the fact that how long this crisis continues, how long that Strait of Hormuz remains closed, and how quickly the supply chains restore themselves. A lot will depend on that. At least on the downside, on the downward side, I don't think rates probably have any more leeway to go down. The market-driven rates, on the other hand, for example, if you look at the 10-year GSEC, or let's say triple rated, bonds or double rated bonds, I would say market-determined rates have some scope to go down from here because they have remained elevated for quite some time, driven by this whole conflict. But so far as policy rates go, I think at least on the CRR, we have used more or less the weapons that we had in our armory. And in terms of repo rate, I think there is very marginal space available there. On the upward side, it will depend a lot on, like I said, on the crude prices, the way they move up or move down.
Okay, got it. Kashyap,
but we have seen in the past that at times, this sips into inflationary expectations. Something that, the term that RBI keeps using every now and then. And that's something that we will have to continue to, sort of keep a razor sharp eye on.
Okay. Any projection in terms of inflationary trends? What you're predicting at this point of time?
Will not want to hazard a guess at this point of time, given the fact that, the crude prices, they close at night and the way they open in the morning, they are completely different. Like, for example, last night it was $118, $20. This morning it came down to 110. Just a day before it was less than 100, or 2 days back it was less than 100. Would not hazard a guess, but let's say, if it continues to stay upwards of, let's say, $90 or $95 for a fairly long period of time, then, the projections of, the RBI projections of inflation might, they might have to tinker on those assumptions at some point of time.
Got it. Kashyap, I was reading your note where it mentioned that a retail fuel hike is imminent in the near future. Elaborate on that.
That would not be our report. It might be part of overall MK Global Financial Services, which is probably the sell side institutional equity business. I'm not sure about even that. But I don't think we have commented on the fuel prices. But like I said, if crude remains about 1995 for a fairly long period of time, excise duty is one weapon that you have to neutralize that. But beyond a point, giving up excise duty revenues for government will also be a slightly challenging task. In the past, what we have seen is that states haven't participated much on their own state duties to mitigate this losses, right? Because then all of them have to work in unison and cut the VAT at the same point of time, which ideally is not something which is very feasible practically. So the large part of that problem of that mitigation efforts, they fall on the central government. But beyond a point, it will be very difficult for them also to bring down the excise duties on either of the auto fuel. At some point of time, then we might see some tinkering on the fuel prices also. I don't want to hazard a guess as to what the number could be, but there could be a possibility down the line.
Okay, got it. Kashyap, your first thoughts?
But am I of the camp that it requires about 25 rupees of stock, of the crude, of the fuel price increase as has been there in a lot of Twitter posts or in terms of some newsline items? My answer is no.
Okay, okay. Is there any projection in terms of the fuel retail hike as well?
I wouldn't want to hazard a guess at this point of time.
Okay, okay. Kashyap, what's your first thoughts on the Q4 results? Any hits, misses, your top takeaways?
So, in terms of numbers, I spoke about Nifty 50 earnings. Top line has been a small 10-digit kind of a growth. EBITDA growth has been roughly about 8 to 9 odd percent. PAT growth has been roughly about similar. But if I look at sector wise, one space which totally stood out in terms of earnings growth number was NBFCs. Particularly if you look at and we don't give out any stock records as such, but within Nifty 50, if you look at Shriram Transport and Bajaj Finance, both absolutely outstanding numbers there. In terms of banks, 2 or 3 private sector banks in Nifty 50 as well as some of the other banks have reported numbers. Though if I look at broad headline numbers in terms of NII growth has been quite modest, but what we have seen is that a significant improvement continues to happen on the balance sheet side, both for private sector banks as well as PSU banks, and particularly ROAs because of the provision line item also improving a bit. We have seen the return on asset ratios also improving by about couple of basis points there. So that's another one which has sort of stood out in terms of overall numbers. IT has been quite modest and which has been sort of expected from that particular sector also, primarily driven by the fact that a lot of the order book which they have been talking about, it's taking significant amount of delays to translate into top line. So IT has been something which has sort of put that number on the EBITDA and PAT growth also slightly under check. But like I said, NBFC numbers have been quite outstanding. That followed by asset quality improvements that we have seen in case of banks, both private and public. On the other side, IT has been sort of slightly, I would not say disappointing, but it's been very weak as expected.
Okay, got it, got it. Kashyap, a lot of experts have been projecting their revising instead their FY27 earnings growth. Are you similarly, trimming it down from earlier before the war started?
So we do not give out Nifty 50 earnings as such. But what I would like to mention here is that today, if you look at, let's say, for example, Nifty 50, the range of FY26 estimates have been anywhere between about 1070 to about 1120, depending on which brokerage houses that you look at. If I look at broadly Bloomberg, they have about anywhere ranging between 1095 to 1107 rupees of EPS on Nifty. At about, let's say, 24,000 Nifty, that discounts the overall Nifty at about 21 to 22 times price to earnings. And if I reverse calculate, that gives you roughly about 4.7% kind of earnings yield. If I look at historically, that 4.7% kind of earnings yield, usually in terms of valuation is quite reasonable in nature. Now let's assume that because of this war going on, this Nifty earnings of about 1090 to about 1110 does not see any upward growth, right? It remains as flat as what it is today. Even when you are in FY27 March or March 2027, what you are going to look at is an earnings yield again back to about 4.7, which it is today, given that we may see earnings remaining flat as we go forward. I don't think at 4.7 earnings yield for FY27 also, the valuations look too alarming to me. They look, sort of quite reasonable at that kind of, earnings yield. So what I'm trying to say here is that irrespective of whether the original 14-15% kind of earnings growth gets revised down to probably a mid single digit when Ukraine-Russia war broke out. Similar thing happened in 2020-22. Unfortunately, in 2020-22, we used to quote at a multiple which was upwards of 25 or a plus kind. Today, we have those valuations in our favor in the sense that even if earnings don't grow, March 27 valuations will still look at about 4.7, 4.8% earnings yield. So I think that looks quite comfortable.
Okay, got it. You mentioned NBFCs are something that you're liking, and IT is something that you're remaining cautious towards. What about FMCG? I mean, that's a big play in the markets right now, and especially after Nestle's results, there's a lot of optimism being baked into the staples companies. What is your position, given the kind of volume growth that the staples have been struggling with?
So, optimism that came with Nestle, unfortunately, HUL also reported the numbers, and
Right.
I don't think that kind of bump up in terms of volumes was visible, quite strongly there. The volume growth has been quite modest even for the quarter. I don't think it got repeated there. So, if I look at overall consumption side, the better way to play probably on the consumption side, I would still say, is through loan book growth, whether it is to do with FMCG or whether it is to do with consumer durable. One of the ways to play that consumption theme, because when you're playing it through, let's say, an outsourcing play within FMCG in terms of manufacturing, or if you're playing in terms of, let's say, retail loan book growth via probably an NBFC route. That gives you a play on not just listed entities within consumption, but a lot of private equity, private players, unlisted players who are actually growing faster than the listed players, and at a valuation which probably might be in your favor versus what generally even still today the FMCG is quoting at. So I think what we are seeing is that consumption is making a comeback for sure. The kind of heat wave that we are looking at across India, I think in terms of consumer durable also, we will see some bump up coming this summer. If you look at commentary of a lot of beverages player also, they have been quite vocal about the fact that the summer this year is going to give a significant bump up in terms of beverages sell also. But I would say the way to play it would be slightly different versus going just via listed FMCG or consumption players.
Okay, got it. All right, just one last question before I let you, Kashyap. Of course, we've seen the kind of crude oil price swings that has been happening. Would you say that OMCs and, of course, the oil and gas sector is one particular pocket that you would avoid for the time being, despite the heavy correction that we've seen?
So as a matter of fact, we have avoided oil and gas as a part of overall portfolio investment for us. That's not really to do with the whether oil prices are up, down, or whether the auto fuel prices are being changed every now and then. The sector has become free and full of reforms. It's been primarily driven by the fact that it's global commodity business, right? Neither of these companies have what do you say a mode in terms of whether they can decide the prices of the raw material, nor can they decide the prices of the finished goods that they are selling. And as a matter of investment philosophy, we like to invest in businesses where if you look at the raw material or the finished goods, the company needs to have a moat in terms of the sourcing as well as the pricing of some of these materials, and that's where we love our investments to be. So if I put some of these companies and superimpose this particular model of having a moat on them, more often than not, they don't form part of our investable universe, and which is why we have not invested in them quite a bit even at any point of time. There might be very minor investments at some point of time, but nothing that we can actually really seriously talk about.
Okay, got it. All right, Kashyap, thank you so much for your time and, of course, joining us. Appreciate your time. We'll
Thank
look
you.
forward to more such conversations.
Thank you so much. Looking forward.